It's not because we're living in scarcity. It's actually because we're living in victory. But also understand that if you create a rule for yourself and something comes up out of the ordinary that you weren't anticipating or whatever, give yourself a little bit of grace at the same time. Don't bury yourself because you weren't able to save the number that you wanted to save. Give yourself a little bit of grace because, Brock, like you said, this is a long game that we're playing.
Without safeguards is only temporary. And so what is freedom in this scenario? The freedom is you have a new income, right? You are now granted an income from your work that you've probably never had in your life. You're coming off your parents' payroll or, their expenses, and now it's on you. And somebody's handing you a big check every month, bigger than you've had before. That's your freedom.
Welcome to the Cashflow Legendz podcast with your hosts, Nate, Brandon, and Brock. Remember, our insights are not direct financial advice, so consult with your financial team before making any decisions based on the topics discussed in this show. Welcome back to Cashflow Legendz. You'll probably notice today we've got one voice that is missing. Brandon is doing one of the things that he loves, which is out playing baseball. I believe he is in the state of New York, around Cooperstown today playing baseball. And I talked to him yesterday. He's having a great time. But today, me and Brock just really wanted to kind of unpack this idea that, whenever we are in school, we get to this place where we've heard a lot of information being thrown at us when we're in school, we're in high school, and then even in college. If we choose to go to college, we've got all this information that's thrown at us. And then we get out into the world and we start applying all of the traditional thinking about how, what we're supposed to do with our money and all that stuff. And then somewhere along the way, we tend to have these epiphanies about maybe I could have done some things a little bit different. So what we're going to talk about today is, people who are between 20 and 30 years old, what are some things that we could do financially to kind of fortify and prepare ourselves for our later years? So Brock, why don't you kind of kick us off with this conversation? With that in mind, when you're speaking to someone who's, let's start off with early 20s, what are some questions that they're bringing to the table, and what kind of guidance are they seeking at that age?
Great question. So the age range that we're talking about here is the age of 20 to age 30. And this age range right here is probably the most important part of your financial life and the most dangerous part of your financial life. And why I say the most dangerous part of your financial life is because if you were to look at a compound interest curve, like an exponential curve, what you find is your first 10 years of that curve are really all your money. Like there's very little interest on top of that. Whereas compared to if you look at the end of the curve, like 90% of it is not your money. It's the interest that you earned. The problem is, though, that you don't get that back into the curve unless you start today, right? And if you don't start today, you don't just lose the front end of the curve because you didn't put the money into it. You lose what could have happened on the back end. And so what happens in the first 10 years, why it's so dangerous, is because you feel like you're not getting anywhere. You feel like you're not doing anything. And so you constantly are changing paths. You're trying to get a new job, a second job. You're chasing rates of returns on deals that you don't even know anything about. So you're creating this risk because you're trying to grow your money without growing yourself. And so what often happens is rather than you starting your exponential curve in your financial life, you just continue to start it over every single year, trying to get somewhere faster, when the reality is you have so much time ahead of you. What you should be doing in your 20s and 30s is focusing on the habits, the systems, and the structures to live into the life that you want later on, to have that success that you want later on. And so, this conversation around the first 10 years in your wealth world between the ages of 20 and 30, they're almost always the same when they come to us, right? I've had 4 of them, I believe, just so far, just this week. And every single one of them is the same. I'm overwhelmed. I'm confused, or I don't know what to do because my parents are saying one thing, my buddies are saying another, TikTok saying another, all these things. I feel behind, which is funny to hear because you just started working. Like, hey, you're going to be okay. You feel behind, or which this is probably the most important, or not most important, but most common, is I hear it every time. Hey, I saw what my parents are doing. They're doing really well now, but I feel like they could have done better in their earlier years, and I don't want to do the same thing. Almost every single one of them says that. And so we'll get into talking about a lot today about, what are those things that you could be doing, where in your life, what habits, systems, and structures could you create for you during these ages?
We talk about the microwave mentality culture, and I was actually speaking with a client the other day about this same topic, and the introduction to credit really changed the landscape of because I mean our grandparents or great grandparents, as an example, they didn't operate off of credit. They operated off of saving up, buying something, not having any debt or anything like that. But then our parents came along, and the introduction of credit and everything like that allowed them to get things maybe a little bit faster than their parents. And then for my generation, the introduction of credit allowed us to leapfrog our parents when it came to what they had, as far as houses and cars and all this stuff. And it goes back to where people feel like they're behind is because they don't realize all the work that it takes to get to that point where you are at that place where you might have a house that's paid off, you might have cars that are paid off or whatever. And you don't see the price tag that actually comes with those things. And so you just assume that since I can afford it according to a bank, then I should have it. And that's a dangerous place to be. It gets a lot of people in trouble. It's gotten me in trouble over the years. I'm not afraid to admit that. But something that I say all the time is a good way to check yourself on a major purchase is to ask, if no one ever knew that I had this, would I still want it? Because chasing status is an empty game. And there's nothing wrong with having nice things. I like nice things. But understanding the heart behind the things that you have is really important. And I think that is a dangerous trap that people in their 20s and 30s, especially in the social media world that we're in today, where there's all the flashy cars and the watches and all that stuff. Like, if you're not careful, you will fall right into that trap.
You will fall right into that trap. And that goes back to a conversation we have more than anything, which is how you handle your cash flow will determine how you lose or grow your wealth. Because all wealth is created through free cash flow. Free cash flow is the difference between the money that comes in your world and the money that leaves your world. And one of the things that I think is the most, I don't know if you'd call it detrimental to younger people, but you always hear this term of, oh, you're young, so you can take a bunch of risk. And I think what gets left off there is they're not saying taking risk with your money, right? Because when you take risk with your money and you lose $1 today, you don't just lose $1 today. You lose that dollar for the rest of your life and what it could have earned. And so what most people are actually talking about there is you can take risk with yourself. You can try the job that you don't know anything about, but you want to try. You can travel the world. You can do these things, but not necessarily, oh, I don't know anything about this investment, so I'm just going to throw money at it and maybe I'll get a moonshot. Well, those are two completely different things. One is ignorance, and one is, hey, I'm trying to find who I am, what I like, what I want to do. And so what we want to talk about a lot of times is when you get your first job out of school, right? Because you have like a lot of people in high school, they'll work their jobs, college, you'll work your jobs, but then typically once you graduate college or you join the workforce, you have more of a what we'll call a career job. And now I always think about these memes. They're like, I've got adult money now, so I can buy adult things. And like you see cars and snowmobiles and all these things. Well, you do have big boy money now. And so you got to make big boy decisions, big girl decisions, whatever. And there, when you start out, your number one goal should be, can I save 15% of my income? Right. And it may be hard to start, but could you save 5% of your income? Right. Because what we know is, yeah, your first job, you might have a really low income and it could be really hard to save some money. That could be the case. Right. When we look at it, one of the things I like to say often is everything starts with awareness. Once we become aware of what's going on, then we can track it. And if we can track it, we can measure it. And if we can measure it, we can improve it. And so we first want to start out. Let's say you got your first job, you get your first big boy, big girl job, and you get this paycheck. And I often see people come in, they'll start out with a $70,000 salary or a $60,000 salary. Well, start from the top and then work yourself down, which is, all right, well, can I save 15% of this income? Right? So take your income, multiply it by 15%, and that's how much money you need to set to the side to think, I'm not even going to touch this. Right? And if you walk in faith and you call yourself a Christian, then it's probably likely that you want to tithe. Well, in that case, what you would do is you get your salary, take 10% off, and then of that new number after the tithe, then you would say, this is my 15% that's going towards wealth building activities. So now you've got 85%. What I would do from there is say, okay, looking at my life today, of this 85% of whatever your salary is, what are all my expenses? Are they more? Are they less? Are they right at? If they're less, okay, well, then bump your savings number up. Or could you say, hey, I'm less than 85% of what I'm spending, but life is pretty tough, or I want to really do this thing. Well, if you want to really do that thing, does that thing improve your life? Does it move you forward? Is it something that would really expand your peace of mind and your mindset? If it is, I don't see why you don't go do that, because it's probably going to make you more productive overall. Now, once you have those numbers, now it's a conversation about, okay, well, what's the process in which we go about this? Spend it and save it. Once your first goal, get 3 to 6 months of expenses saved up, right? Start with a goal of 3 months. And what oftentimes we'll see people really early in their career, like in their early 20s, like you brought up there, Nate, was some of them might still be living at home, right? If that's the case, why don't we go ahead and create a savings based on if you are renting a place or you owned a place? That way, when you do go into a place that you're already renting or moving into, you've got two things that you know to be true. Number one, you've already been saving the amount of money that you're going to be spending on rent, and you know you're in the green. And then two, once you move into that place, you'll have 3 to 6 months of expenses of that rent or mortgage saved up. And so now it becomes a tool for you to have, and you can really start moving the ball forward. What would you say about
that? Well, what it made me think about is you kind of have two different types of people who come to you at that time. Some who are going, okay, this is brand new to me. Like, I'm finally making money. Like, what do I do? And then you have others who have already figured out, because they've already kind of spread themselves so thin, that they're having a really hard time saving money to begin with. And what I've seen in those situations is if you've been having a hard time saving money, we're going to start with a small number and we're going to build on top of that, because it's a whole lot easier to start small and gradually increase that spread as far as your wealth gap, the difference between your income and your expenses, than it is to try to take a chunk out of it and then feel the stress of trying to make the rest of it work. And so starting small and then building on top of it can be really powerful. One of the examples that I know that you share and we share as well is this idea of this exercise of the value of cash flow structure. And in that exercise, we're only using a 4% savings rate. And so what we're effectively doing is showing someone how they could potentially be spending 96% of their money their entire life and still getting ahead, which is really wild to think about. But it's because you create rules for yourself on how that's going to be used. Now you're starting out at 96%, but with proper structure in place, that gap starts to spread more and more over time. But there's a lot of peace when you create a rule for yourself and you're able to live within that rule and accomplish that. And it's not because we're living in scarcity. It's actually because we're living in victory. But also understand that if you create a rule for yourself and something comes up out of the ordinary that you weren't anticipating or whatever, give yourself a little bit of grace at the same time. Don't bury yourself because you weren't able to save the number that you wanted to save. Give yourself a little bit of grace because, Brock, like you said, this is a long game that we're playing. We've got plenty of time to right the ship, create the efficiency that we want to create in our life to move us forward at a rate that we didn't even know was possible.
That's right. And one of the things that you want to think about is the rule is not there as a bad thing. Like, don't move past this, don't do this, don't do that. No. Number one, discipline equals freedom, right? That comes from Jocko Willink, I think. When you have discipline, you have freedom. You get to do other things. You get to enjoy life and being present. And one of the things that you'll probably hear me say a lot is freedom without safeguards is only temporary. And so what is freedom in this scenario? The freedom is you have a new income, right? You are now granted an income from your work that you've probably never had in your life. You're coming off your parents' payroll or, their expenses, and now it's on you. And somebody's handing you a big check every month, bigger than you've had before. That's your freedom. But if you don't put the safeguards in place, that freedom will only be temporary for a while, and that freedom will become a hindrance, because now what we see happens, especially just through statistics, is the fact that most people on average are spending 96% of their income. If that's the average, that means some people are spending more than 96% of their income. And so what you see is if you don't put the safeguards in place around you, you could end up spending all of your income. And if you're spending all of your income, there's no way that you'll end up having financial freedom or financial independence later, right? And so you want to have those safeguards in place. And this is where we talk a lot about your cash flow structure. And when we talk about cash flow structure, most of the time in our world, 99% of people live in a place of what we call unconscious consumption while trying to manually save every dollar, right? And so most people, they'll get their paycheck and they deposit it in their checking account. And if there's money left over, you'll move it into your savings. When you're young and you start your career, this is like almost the exact thing that happens every time. I hear it over and over again. Oh, well, my parents set this up when I started getting money when I was a kid. My parents set this up when I was in school. Oh, I set this up when I got my first job. I set this up so-and-so. Money starts flowing into your checking account, and then eventually you're like, oh, wait a second. There's a lot of money in my checking account. I should open up a savings. So you go and open up a savings account. You start putting money in there over and over again. But slowly and surely, unconsciously, you start spending money. You might not be thinking about it, but everything in our world, especially in America, is programmed to help you spend easier. How do I know that? Well, look at every ad, look at everything out there. Double click your phone, tap it, you're good to go. I even got a notification from Apple the other day that said, hey, you have Apple Cash. You should go spend it or send it to somebody. It literally said that. And I'm like, man, this is such a easy thing to see. If everybody wants you to get rid of your money, right? They want to separate you from your money.
Yeah, there was an app that came out a few years ago, and I don't remember the name of it, and I don't want to even plug it. But I remember the premise behind the app is essentially that they would loan you your paycheck before you got your paycheck.
Yeah, still around.
And I was like, "Oh my gosh, like how dangerous is that for people?"
Very dangerous.
Which is really like you were talking about earlier, the ease of use. It's basically a payday lending app is what it is. You know, where you don't have to go down to the payday lender now. You can just pull up the app on your phone and you get the same result, so to speak. And payday lending industry. Go ahead.
It's even the same when they introduced you could now put your DoorDash on
credit.
On credit. It's like, come on.
You can finance the food. How are they ever going to get that food back?
Yeah. That stuff is ridiculous. And so you want to be able to structure your cash flow in a way to where rather than having your paycheck deposited in your checking account and then moving money to savings, you want to take your paycheck, deposit it in savings, and then remove money that you only need to spend back into your checking account to spend. Because your checking account, its one and only job is to pay for expenses. Nobody cares about the interest rate. Nobody cares about the tax benefits. It is only there to spend money. And what typically happens is, if you look back, I'll do both sides of the coin here. If you look at when you were a kid, your parents probably gave you money as you went to the bowling alley or the ballpark or whatever. You figured out how to spend all of the money. It was very rare that you came back with more money or money at all, right? Like I remember I would have 3 quarters left. Okay, let's go buy as much double bubble as we could probably get, right? Or let's go get an icy that I'm not even going to finish, but I need to get rid of the money. The same thing is true as you become an adult and you get a big job. It just changes hands from you getting paid from your parents to you getting paid through your payroll. And the same thing is happening. Your brain says, I was given money. It's in my hands to spend, so I'm going to spend it. Well, if you don't do something to interrupt that pattern, the pattern will continue on as you spending more of it. The same is true as you become an adult and you buy a house. Oftentimes you'll think, man, there's no way I could ever fill this house. And then you go to move and find out, oh my gosh, I've filled the house. That's what Parkinson's law is. And so our preferred method is using currents. Currents allows you to do 3 super important things with your money. Number 1 is separate your income from expenses by setting up what we call your income reservoir. Paycheck now flows into your income reservoir, and then we remove the money, only that of which we spend per month, into our checking account. Well, that's the first step, is separating our income from our expenses. The second step is, how do we automate this? Number 1 is the easiest. You just move your direct deposit from your work into your income reservoir. The second automation that you set up is the money that moves from your reservoir into your checking account. Now, you could probably do this on your own with a checking account, but we'll get to why you might not want to do that in a minute. So that second piece is you automate the money removing or leaving your reservoir. Well, if I have more money coming into my reservoir than going out, the third thing that gets automated is my savings. I now no longer have to think about saving my money manually. It just organically and automatically happens. And something that I think about a lot of times, especially with younger people, is if you did the math, right? And let's say that we'll go right in the middle. Let's say you're 25. So you take 65 minus 25, average retirement age, that's 40 years. If you get paid 26 times a year for the next 40 years, That's 1,040 times at minimum. Not to say anytime that you get a bonus, you get a check from somebody for selling something, you buy a rental property, and now you got more checks coming in. Like 1,040 is probably the minimum amount of times that you're going to get paid. Do you really think you'll never mess up moving money 1,040 times from your checking to your savings? Go ahead and automate it. There's no reason for you to do that manually 1,040 times in your life, right? So we want to automate that. And then the third piece, which I believe is the most important, is having something that gives you timely data. One of the things that, just this week, a younger family, 29 and 28 years old, I think they were 9, the kid was 10 months old or something. They were overwhelmed. They're confused. They feel behind. They don't know what to do. Well, where do we start? Awareness. They kept talking about, I feel bad because we spend over our budget. I feel bad or I feel uncertain. I have anxiety because of the fact that I don't know where my money's at. And I feel bad when we overspend, all these things. Well, let's become aware of it. Let's use a tool that gives us timely data. So what do we use? You and I, Nate and Brandon, we all use currents. Well, when we set up currents and we set a target reservoir balance, we know either how close we are to hitting that target or how far above we are that target. So now, if we're above the target, we don't have to fret. Like, let's just go consume the money or go invest the money. Now we don't have to worry about, I don't know about my savings. I don't know if I'm going to be okay next month. No, it's going to happen. You're going to be okay because now you are aware of what you want. You can track it, you can measure it, and you can improve it if need be. And you'll also know very quickly on that timely data piece is, hey, are you spending less than you make? That's rule number one in every book out there. Just spend less than you make. And if you do that and you have timely data that gives you that, now you can build confidence to know you can actually make financial decisions and not have any anxiety about it because you know where you're at. You're aware of it.
Yeah, and that confidence piece is so incredibly important. We meet people where they're at, and we are experts in the types of strategies that we create for people, and it often starts with currents, and from that, it often involves a whole life insurance policy for very specific reasons. For somebody who has never funded a whole life insurance policy before, like this is a brand new thing for them, one of the things that I see so often with people who start using currents is it shows them what they're capable of creating. Shows them what they're capable of doing. And also, like you said earlier, it builds resilience for them. It builds up their Murphy muscle, so to speak. Murphy's law says that, if something can go wrong, it will go wrong. And so it gives us the ability to aim towards a target and know that even when things don't go the way we hope they were going to go, we're still moving in the right direction.
That's right.
And I'll just use Dave Ramsey as an example. His baby step one is save up $1,000. And that's great. If you can save $1,000, that's great. But man, $1,000 can be gone on a Tuesday when something unexpected pops up.
That's right.
And so your first priority should be to build to that 3-month mark. Start investing in yourself before you start investing in anybody else's assets that they're offering you.
That's right. And I think one of the things, so if we kept moving the ball forward, one of the things that we often get asked is, do I do my 401k? Do I do a Roth? Do I do whatever it may be, right? When you are young, right, and when you are old, the principle of the order in which we do things is important, never changes. When you're young, you should not be funding your 401k until you have at least 3 months of expenses saved up, regardless of whether you have a match or not. Because if you fund your 401k, but yet you have no emergency fund and something happens and you have to go in credit card debt, now you have to figure out how to dig yourself out of the credit card hole debt or debt hole in general and then start saving. And what often happens, and you can see it in all the statistics out there, is nobody ever gets out of the hole. They just continue to repeat the cycle over and over again. So if you're starting your job, you're starting your career, there's no reason for you to start your 401k until you have 3 to 6 months of expenses saved up. After that, if you want to, sure, fund your 401k and only go up to the match. Ideally, you would do it to the Roth portion and you would let your employer put it in the traditional 401k, but only up to the match, because then you have to ask yourselves other things like, do you think taxes are going up or down in the future? Do you think you will make more income into the future? Do you need access to this? Because what often happens is, as younger people, we've always been told you got to save money for the future, do it through your 401k, and you got to pay off your debt as much as possible. You see this a lot with cars. Somebody's going to listen to this and they know I'm talking about them. We have this conversation a lot, and they're like, "Oh, well, I've got extra cash to save." So what they'll think about is, "Oh, I'll go pay it towards my truck note instead of putting it towards my emergency fund that I'm not at my target yet." All right. Well, if you pay towards your truck note, number one, does it reduce your monthly payment at all? No. All right. So if you pay it towards your truck note and it doesn't reduce the payment at all, but yet an emergency happens in your life and you don't have the money because you tried to pay off your truck earlier, what happens? You go into more debt. Again, the cycle continues. So we want to pay as little as we can towards debt first, get your savings right, then you can go towards debt. The same is true for a 401k or an employer retirement plan. Is they say, "Oh, well, I need to start saving money here so that I can grow it over time." That might be true, but if you don't have savings and you're putting all your money towards your 401k, something happens, you're back in the debt. Or you might be funding your 401k, but you're strangling yourself with debt over here. Stop your 401k and pay the debt off. Get your money right before you start trying to grow it somewhere else.
Yep. And, all three of us, we played sports, so we're athletes. So team sports is something that's really relevant to us, and it's very much in line with our philosophy of finance. And so when you think about offensive positions, those are going to be savings and growth type things, or really growth more than anything else. But then defensive positions are protection pieces. And when it comes to playing offense, we want to play really great defense to give our offense better opportunities. So playing really great defense means that we're protecting our income in the best way possible. And that can be done a couple different ways. Disability insurance is definitely one of them. Having assets that cover our expenses is another way that we can protect our income. So like passive income and things like that. And then also whole life insurance, it offers something called a disability waiver premium that would step in and pay our premiums in the event that we did become disabled. And now we have a self-completing strategy to make sure that if everything goes the way we hope it's going to be a really great life. Yep. But even if things go wrong at some level, we are still planning for those things. And we don't get disrupted so much that we're just living the rest of our life in survival mode.
That's right.
And so the first step in playing defense is protecting your income and also building up your resilience and understanding that my access to capital and my efficiency with that capital is the most important thing first before I go invest in anyone else's business or other assets that are out there. And when we are playing a game that way, this kind of leads into the win then play philosophy that Garrett talks about in Money Unmasked. Whole life insurance specifically gives us the ability to buy our net worth ahead of time and then build and grow into it simultaneously. So for someone who's young in their 20s or 30s, when they're going, "Man, like I feel like I'm so far behind, I don't know if I'm ever going to get ahead or anything like that." Well, what if you could see a number that actuarially speaking is representing the value you're going to create in the future without any guesswork whatsoever? And now you get to build and grow into that. I think there's a lot of peace that comes from that when I see people who are walking through our process, but also it gives them a lot of confidence about what they're going to be able to keep and create in the future.
Yeah, that's a good point. And I would say the disability waiver of premium is not just for whole life. Like you can get it on term insurance as well. And so there's a lot of people like they'll talk about you should just do whole life insurance and that's it. Well, that's not the case. You only do whole life insurance and you do it only when and after you've protected your life. Life insurance comes first. The death benefit is coming first. Once you have at least 3 months of expenses in the bank, and you've got the protection of your income for your family, then you move into whole life insurance. And Nate, you're correct. Like we buy our net worth because there's really only two reasons we save money. Only two that like if we're setting money aside, there's only two reasons: a future use for income or a future use for legacy. Those are the only two. And legacy could be you give it to your family. It could be you give it to a charity or something that you care about, right? Those are the only two places that it goes, right? Income or legacy. And so what we want to be able to do is how do we build our life in a way that we can maximize both without giving up the other, right? And so, as you're young, we'll start wrapping up here. When you're in those first 10 years of your career, don't feel alone in the fact that you probably feel overwhelmed, you feel behind, you have anxiety around money. Know that you can overcome those things when you think about how do I become aware of what I have? How do I become aware of what I have? And how do I become aware of what I want? And when you know those two, now you can start measuring or tracking them. Once you track it, you can measure it. Once you measure it, you can improve it. And so starting out, get your cash flow right. Know what you're spending. Know what you're saving. The goal there is 15%. After that, what you want to do is you want to save up somewhere between 3 and 6 months of expenses. If you want more than that, great. Whatever you feel comfortable with, but nothing less than 3 months of expenses. Once you have that, then go look at your 401k. But don't fund it. Don't fund your employer retirement plan until you have your emergency fund set up. Then it's a discussion of do I do my 401k or do I handle my debt? But don't go trying to pay off your debt if you don't have your emergency fund. Don't try funding your retirement if you don't have your savings or you're strangling yourself with debt. Start with the basics. Because if you want a really big building, you dig a really deep foundation. If you just want a small little home, sure, pour a slab. But no, it's probably going to get knocked over.
This is a really timely conversation because if you're watching right now and you don't know this already, I have a 21-year-old. I don't look my age. I never have, but he's got 2 semesters left in college. He's done some various side hustles while he's been in school to make some spending money and stuff like that. But since he's only got 2 semesters left before he kind of gets launched out into the real world, I've told him, dude, if you will listen to me and do the things that I'm telling you to do and teaching you, you will be better off than 99% of all the people around you, because most people don't know these things. And so we have people from all ages who listen to the show. And so the encouragement that I would give you is no matter what your age is, lean into learning, because the more that you're able to take in and apply, the higher plane you're going to enable someone else to start out at, a child or a grandchild. The more information you know that you're able to pass on, the better opportunities you're going to give them to be successful and really win their game,
That's right.
Brock, anything else?
Nope, I think we're good. We'll pick it up later.
Well, thank y'all so much for listening. Hit the like, subscribes, all those fun things that helps the algorithm, as Brandon likes to say. And we'll catch you on the next one.